Has the market bottom or its more correction is coming? With US tariff, RBI policy and global cues adding to the uncertainty, what next for the market? Let's find out. Nifty 50 has dropped 13.4% in last 4 months, but the real damage run deeper. 907 BSE stocks has hit 52-week low and over 1000 stock has crashed at least 30% from their peaks. Even in Nifty Midcap 100, 50% of stock has plugged up to 60%. Individual stock has been hit even harder, with many portfolios sink 20%, 30% or more. So why did the market crash? Valuations had reached extreme levels, making the market ripe for a correction. All major indices were trading near their all-time high on 26 September. P/E ratio of Nifty 50 hits 24.4, well above its historical median of 21.9. The broader market was even more overheated. Nifty Midcap 100 soared to a P/E ratio of 45.5, double its median of 22, while Nifty Small Cap 100 P climbed to 36.4, far above its median of 31.8. This stretch valuation leaves little room for error, and when sentiment turned, the sell-off was swift. Tightening liquidity and aggressive profit booking accelerate the downturn. Mid and small cap stocks, which has seen a massive rally, face the worst hit as investors rush to exit. Weak earning growth in the key sector and added to the panic, leading to sharp and widespread correction. But valuation were not the only trigger. Massive selling by foreign institutional investors added to the pressure. In the last few months, FIIs has dumped nearly 3 lakh crores worth of share, pulling liquidity out of the market. This relentless selling put further strain on already weakened sentiment, accelerating the downfall, especially in mid and small cap stocks. As it heavy FI selling was not enough, the rising dollar index added more pressure on market. As stronger dollar makes emerging market like India less attractive for foreign investors, leading to capital outflows. With the dollar index climbing steadily in recent months, FIs further accelerate their selling, adding to the market weakness. Adding to the market trouble, the Indian rupees has also come under pressure. As the dollar index surged, the rupee weakened, making imports costlier and increasing inflation risk. A weaker rupee also reduces foreign investor returns, pushing them to withdraw even more funds from Indian markets. The currency depreciation coupled with aggressive FI selling has only intensified the market downward trend. While the Indian market struggled, the US market tells a different story. In the same period, the S&P 500 delivered solid 7.8% return, making it more attractive option for global investors. This outperformance further drove FIs to ship their money out of India, worsening the sell-off. With foreign capital flowing toward the stronger performing market, India faced the brunt of outflows, adding to the pressure on stocks. Any other major factor behind the market sell-off was the sharp rise in US 10-year bond yield. As yield climbs, US bonds become more attractive to investors, offering safer and better returns compared to the riskier equities. This leads to a shift in global capital, with FIs pulling money out of emerging markets like India and redirecting to US bonds. With the rising global risk, investors rush towards the safer haven asset, pushing gold prices higher. As gold becomes more attractive, funds move away from equities, added to the selling pressure in a stock market. If you are finding this analysis insightful, make sure it likes, share, subscribe to stay ahead of market trends. Your support helps us bring more in-depth market breakdown. Hit the bell icon so you never miss the update. Now let's dive deeper into when the correction will be over. To understand this correction might end, let's look at the history. In last 25 years, Indian market has seen multiple major correction of more than 20%. The worst crash comes in 2008, when the market plucked 64.6% during the global financial crisis. The longest correction lasts for 576 days, starting in February 2000 after the dot-com bubble burst. But history's most brutal downward was the Great Depression. From 1922 to 1932, the US stock market crashed nearly 90%, and it took almost 10 years for a full recovery. Correction vary in depth and duration, but all comes to an end. The market correction has started to reflect in valuation. Nifty 50 PE ratio has declined to 20.4, bring it closer to its historic median of 21.9. Nifty Midcap 100, which had surged to 45.5, has cooled to 33.6 through its remain above its median of 22, while Nifty Small Cap 100 has dropped from 36.4 to 26.9, now below its median of 31.8. While small cap are trading below their historic average and mid cap still appears stretched, indicated the valuation risk is still unfolded. Indian inflation rate is now with the RBI target range of 2% to 6%, providing some stability to the economy. After months of higher pricing, cooling food and energy cost has helped bring inflation under control. With inflation staying within a limit, the pressure for aggressive rate hikes has been eased, supporting market sentiment. While this offers relief, global uncertainty and other economic factors continue to influence the market trends. Adding to positive signals, interest rate has been cut by 25 basis points. A lower interest rate is borrowing costs for business and consumer, boosting economic activity and improving market sentiment. This shift in monetary policy would provide much needed support after months of tightening liquidity. With inflation under control and rate cuts beginning, the environment for market recovery is improving. Indian GDP growth rate remains strong, standing out of one of the fastest growing major economies. Despite global challenges, resilient domestic demand, government spending and the robust services sector has supported steady economic expansion. Stronger GDP growth provides a cushion against the market volatility and reinforces long-term investor confidence. With stable inflation rate, cuts and solid economic growth, market conditions are showing sign of improvement. The conclusion: the market has seen a sharp correction due to higher valuations, FI's outflows and global uncertainty, mid and small cap stocks has cooled, inflation is under control, and interest rate has been cut. Indian stronger GDP growth is providing support and market conditions are improving. While risk remain the worst of correction could be over, whether this is a recovery or a just short-term bounce, staying informed and cautious is key. That's it for this analysis. If you find this helpful, don't forget to like, share and subscribe for more market insights. Stay informed, stay ahead and happy investing. Thank you.